Hey guys, what's up? In this training, I'm going over how to turn simple credit spreads into a mathematically guaranteed money machine. I'm going to walk through what are credit spreads, both the call credit spreads and the put credit spreads, how to set them up, what environments they make money in, and different type of situations like that. I'm also going into knowing what level to use for your credit spreads, knowing what strike prices to select and why, going over both a delta and a technical analysis perspective. Then I'm going into using a secret hidden strategy, trend following, that can turn a 20 delta into a 90% plus win rate, which is insane. And I'll explain all that in this video, and also the proven mathematical strategy, and I'm going to show you how and why that works. All right, so let's jump into the video. Number one is, what are credit spreads? If you've never traded credit spreads before, welcome to this training. This is for you. But a credit spread is a simple option strategy that allows you to make money in different scenarios. So scenario number one, let's say we're trading a call. I know I'm terrible at doing this, but let's say this is a call credit spread. A call credit spread makes money when the stock goes down, makes money when the stock stays the same, and makes money when it goes up slightly. The reason being is because when you're putting on a call credit spread, you select a level. Let's say it's this level and the stock is currently trading right here. You make money as long as the stock stays below the level you selected. So if I selected this, I make money if the stock stays below it. I make money if the stock stays the same and it's still below it. And I make money if it goes up but still stays below it. So that's the beauty of credit spreads, especially a call credit spread, is you have so much more potential to make money. Why? Because when you buy a stock, it's 50-50. Either it goes up or it goes down. But a call credit spread or any type of credit spread, you buy it, you sell it up front, and you have way more chances to make money. Because if it stays the same or goes down or even goes in your against you, like goes up, but doesn't go all the way into your level, then you make money. So you have three different ways to make money, which is a stock, you just have one direction. Now the put credit spread works the exact opposite. So we have put credit spread, it's going to work. Let's say the stock is currently trading here. For a put, I make money to the upside. So because of the upside, I need to select a level below it. And so I put credit spread, let's say I select this level as my level. So as long as the stock right here stays above this level, I make money. So that means if the stock goes up, I make money. If the stock stays the same, I make money. If the stock goes down a bit but stays below stays above my level, I make money as well. So this is the option of a call credit spread, which makes money mainly to the downside, and a put credit spread, which makes money to the upside. So those are how credit spreads work. You structure a credit spread by selling one option at the level you want, and then buying the one below it or above it, depending on if it's put or call, to protect your downside risk. So let me walk you through this as an example. If I pull up my trading broker here and I go to, let's say, SPY, and I click on trade and on the trade tab, let's just go to this right here, a 7 days right here. Okay, so like I said, what you're doing is you're picking a level where you think the stock will stay above. Let's say I think it's going to stay above, first off, you need to have an idea of which direction you think it's going. Do I think it's going up or staying the same, or do I think it's going down and staying the same? Well, if it's going up and staying the same, which is what I'll say because it seems pretty red, so it's most likely to rebound. But again, I'll be talking about strategy later in this training. Let's say I think the level is 400. Okay, cool. So I'm going to sell that 400 level. So I'm selling this option first. But again, when I sell an option up front, there's a lot of max loss. Right here, look at almost a $400,000 max loss and a buying effect, which means I have to put up $76,000 to put this trade on, with a max profit of $2,500. So again, that's a lot of risk. Nobody wants to put on this kind of risk. So to define your risk, you're going to buy the one right below it. So again, that's this one right here. Since this is 400, this is 399, it's below it, even though it's above it on the options chain. Now, my max profit is 270, but my max loss is 720. So now again, my loss is defined, so I do have a smaller profit because of that, but now I only have to put up $720, and that's the beautiful part of this trade. So I make 280, and I risk about 700. But again, as I'll show you in this training, I'll show you ways so that you only lose maybe 1 out of 10 times, so that you're going to make money in the long run. Now again, that is how you set up a put credit spread trade. Now if we go to the call side of the table, which is on the left side, let's say I think it's going to stay below 410. I'm going to sell the 410, and then I'm going to buy the one right above it, and that's going to define my risk, and which means I can make 350 $50 while risking $650. So that is how you set up these trades. You sell at the level you think it's going to either stay at or say below or above, depending on if it's a call or credit spread. A call or put credit spread. Then you're going to define your risk by buying the one next to it. All right, cool. Now let's jump back to the whiteboard. Okay, cool. So now that we know what credit spreads are and how they're structured and how they make money, that should be fairly simple. Again, next we're going to learn, okay, what level do I use, right? Like I showed you, you select a level. How do you know what level to use? Well, there is one method called technical analysis, and there's another method called using delta. So let's start off with technical analysis. So if I jump into the chart here, you can see this is a chart of the S&P 500. So when I'm looking at this chart, I'm going to look at what is happening with this chart. What are the levels? What are the trends? What's going on here? And to assess that, I simply just bring up this chart or this indicator, and it shows me what's going on. If the stock is above this line, it's trending up. If the stock is below this line, it's trending down, and it shows me different scenarios like that. But to keep it super simple, let's remove this and let's do it from scratch. So if I go here and I add moving average to my chart, moving average, just like that, and then I'm going to come over here and I'm going to edit this moving average. Okay. Let's reload the screen just to fix it real quick. Yeah, I didn't even save it. That's how much off it is. Okay, here we go. Now let's fix this moving average. Go here to moving average, be able to change the settings, and we're going to change this length to 200. Perfect. Just like this. All right, so how this works, in general, if the stock that we're looking at is below this blue line or below the 200-day moving average, the market is going to be bearish. What type of trade do we place when the market is bearish? A call credit spread. When the stock is above this line, it's known to be bullish, which we put on a put credit spread because that makes money mainly to the upside. So that's one way to determine trend, but another way is by looking at technical analysis or different types of levels. So when we chart out our support and resistance levels, for support, we look at our lows. Where are our lows? We have a low here and a low here. So let's put a support here. Where is another low? Well, we've had another low right here. I guess we can say that, might as well, but we're just basically double lapping our support. Anyways, basically we have a strong support level in this region. Next, where's our resistance? Well, we look at our highs. You can see here we have a resistance right here because we hit it over and over and over right here. But if we zoom in, we also have one right here. Why right here? Well, because you can see we had consolidation right here. We've hit it here a few times. We've stopped and rejected right here. We've rejected right here, and we've rejected right here again. So you can see here that we have resistance and support levels. So when we're looking at this, what's another way to know where to put our levels when trading credit spreads is, let's say we're trading into this level and starting to turn around. Well, what are we going to do? We know we're hitting a resistance level and we're starting to turn around, and that seems to happen. So we can put on a call credit spread right here with our level being above this, right, with our high right here, because we think it's going to stay above this previous high. So if we think it's going to stay above here, set the call credit spread here and let it run lower. Now to the same way to the downside, let's say it's bouncing here. What are we going to do? We're going to put it on a put credit spread with our level below this low so that we can kind of make money and ensure that it kind of works out in our favor. So that is how we set up different levels. But another way to trade credit spreads is based on delta, not even looking at the chart at all. So if we go back to our trading platform, you can see here we have a tab right here that we can change among all these things called delta. Delta gives us our theoretical win rate based on math, like based on the expected moves and how much volatility there is. It shows us what we can expect the stock to do over the next certain amount of days. So let's take a look at this. All right, so our delta right here changes. The closer it is to the stock, the closer to 50 it will be. So again, you can see here we have it close to it's around 50 where the current price is. Why? Well, because that means it has a 50-50 chance of doing something, right? The same way with the stock. When we buy a stock, we have a 50-50 chance of it doing something. The further we move away, that shows us the odds of it expiring below the price, or the stock price getting below it. So for instance, right here at a 0.17 delta, that tells us there's a 17% chance that the stock will get below this level. So how can we use this as a credit spread trader? Well, putting on our trades, we can put on a trade like with the 0.17 delta, meaning that we have a 17% chance that the stock hits this level. So what's the inverse of that? If there's a 17% chance it hits that level, that means that there's an 83% chance that it doesn't and we make money. So that means that we can put on this trade just by looking at the delta, knowing that it has an 83% chance of making money, and we can sell and then buy, and now we can collect 13 cents or $130 and have an 83% win rate. So again, that seems pretty good, but again, you have to factor out, is the max profit worth it with the win rate and all that stuff to see if you'll make money long term. And that's kind of how you determine, either using technical analysis or delta, what type of stock you're going to be, or what type of level you're going to be trading at. All right, next is outside of the levels. How else can we do this? For instance, is there a strategy where I can know for certain that I'm going to have a certain win rate, but also collect enough money to offset it in the future? Why? Well, because let me just pull up this. I can't really do math on here, but like, look, let's say we have 100 trades and you have an 80% win rate. Let's use the example that we just pulled from the trading chart, right? There's an 83% chance of winning using the delta, and you collect 13 cents. That means on the downside, you're going to risk 87 cents. So let's take a look at this. Let's take a basket of 100 trades. So out of 100 trades, let's say you have an 83% win rate. That means you're going to win 83 trades. So on each of the 83 trades, you're going to make what? 13 cents. Okay, cool. But now how many losing trades will you have? You'll have 17 losing trades out of a 100 trade basket. And how much do you lose per losing trade? Well, you're going to lose 87 cents per losing trade. What does this give us? This gives us a -4. That means that in the long run, if we take this trade with an 83% win rate and only a 13 cent credit, we're going to lose money in the long run. So again, that's something that we do not want to do. -4 is not a long-term expected win rate. So how can we pick the right levels that gives us a high win rate and delivers great returns in the long run? That is what is known as a trend following strategy. Again, what we do is we look at where is the market going. So before, we were charting out levels and we were looking at stuff like that. So let me remove all these drawings, and instead let me look at what is the market currently doing. So we do that by factoring in one simple thing. Remember I said you can look at this 200-day moving average and say, is it above or is it below? Right? If it's above, the market's bullish. If it's below, the market's bearish. And so when we do that, now we know, okay, the market is above this blue line. So even though it's coming down, this is a bullish market. So I'm going to put on a put credit spread. So now we're going to put on a put credit spread. So what we're going to do, we're going to go into our platform. Again, you want to give it about 2 weeks to put the trade on. So this is about 2 weeks right here, May 10th. So again, we have about 14 days left. What we're going to do is we're going to put on a put credit spread. So let's see here if we have about a 20 delta. Going to be right here, about a 20 delta. That's about $10 wide. I already have one on right here. You can see the trade that I have on right now, but let's move it to right here. Okay, cool. So we're about 2 weeks out, and we have about a 20 delta right here. You can see here 0.2 is our 20 delta. So we put on this 20 delta, which means we're selling this one and we're buying this one. That means that we collect 16 cents and we have a theoretical win rate based on delta of roughly 80%, right? Because it's a 20 delta, which means we have a 20% chance of it hitting our level. So that means we have an 80% chance of it not. So we have an 80% chance on this trade of making money. So that is the theoretical win rate. But I can tell you based on backtests I've run, which I'm going to show you in a little bit what these backtests are, that when we're trading with the trend, this 80% win rate historically jumps up to 90%. So let's take a look at those numbers again. What happens if we're trading a delta of we just were, but instead of an 83 or an 83% win rate, we have a 90% win rate. So let's jump this up to 90 trades. We're going to make money. And this means that 10 trades were not. Well, now guess what? With keeping the return the same, now we have a positive return. We have a positive 3, which tells us in the long run, we're going to make a positive $300 for this trade. So that means out of 100 trades we do, we're going to make $300. But if you didn't notice, we're actually collecting 16 cents, which means we're actually going to have a lower wing, which means we're actually going to collect $600. So that is the beautiful part of using this trend following approach. When you're trading with the trend, when you're going with the trend and looking at what the market's doing and put on a put and call credit spread in relation to that, you can actually really increase your win rate by a massive percentage and change a net loser into a net winner. So what is the strategy? What is the backtest? What am I talking about? Okay, cool. Well, I put all together the backtest right here. So let's look at the S&P 500 historical performance. Okay, so we're looking at a $1 width, and we're looking at, for instance, right here, the true turtle strategy, which is an uptrending strategy. So when the market is trending up, this is how we put on this strategy. We look at a market that is trending up. So for instance, right here would be an example of a market that is trending up. We go out 2 weeks. We put on this trade, we go 3% below the current market price, and that's how we put on a trade. So that is how those trades are put on. Now, if we look at that, since 2007 to 2023, we had an almost 6,000% return. That is an annualized return of roughly 35%. Who here would like to make a 35% return every single year? That's the beauty of putting the correct credit spread in your favor. You can see here we're collecting about the credit we saw on the example I just gave. And again, you have a 95% win rate. So you will have these losers, but long term, you can go even years without even experiencing a loss. You can see here, no loss, 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 loss. But you can see here, you can go forever without experiencing a loss and end up with a net profit. That's the beauty of this. Again, these are all backtested and proven and works. Again, I use this for myself and so do my members. But you can see here, this is the beauty of trading with the trend. So this is called the True Turtle strategy, and it's the way to make money. Now, again, if you click the link in the description below, I'm actually going to give you my trading handbook for free, which is going to walk you through how to implement this strategy so that you can know, okay, how do I use the turtle strategy during uptrending markets? How do I use the short play strategy in short and bearish markets for a call credit spread? I'm going to walk you through exactly how to place all these trades, and I'm giving it all to you for free because I want you to have access to it. If you want access to this platform, though, right here, which will give you the trades and tell you exactly what to do step by step to have these high win rates and collect at least a 15% return per trade. Right here is the Trade Ideas Algo, which I'll link below as well and give you a discount for watching this video and staying through to the end. Again, I'll link that below as well. So all this is available to you. If you're still on the fence and you're trying to trade credit spreads for the first time and you're still learning and trying to understand what's going on here, well, I'm going to give you the opportunity today to actually get trades for free. So if you click the link below with that discount, again, you'll be able to join the Credit Spreads Inner Circle program. But even if you don't, scroll all the way down to the bottom and click on this link right here. Want to test our alerts. I give you 3 free alerts that you can start in place today so that you can actually start making money. So whether you have no experience in this market or have no options experience, no credit spread experience, or maybe you have experience but you want more consistency, you want to be more profitable, you can follow these alerts here that I'll send straight to your email so that you can take advantage of these trades. All right, guys, I hope you enjoyed this video. If you did, please smash that thumbs up button and subscribe button as I walked you through the credit spread trading strategy. Now, again, if you want to learn more about credit spreads and see other quick training videos, make sure to smash that subscribe button because I have so much more coming. All right, I hope you guys enjoyed this video. I will see you in the next one.